Today we will be discussing the double entry system of bookkeeping. We will understand the rules of debit and credit through the DC dealer trick. Then we will understand further about the double entry system, and then we will also learn how to prepare ledger accounts. So, rules of debit and credit. On the left side we have debit and on the right side we have credit. So in accounting, in a T account or ledger accounts, the left hand side is the debit side and the right hand side is the credit side. There is no further logical reasoning behind this. This is how it is and we have to learn it in this way. Now to further understand the rules of debit and credit, we need to learn the term dealer, DC dealer. That is, DEA are on the left hand side of this line, this is the blue line, and LER are on the right hand side of this blue line, which means that DEA, that is drawings, expenses and assets, increase on the debit side and decrease on the credit side. We have to learn this. And on the right hand side we have liabilities, equity or owner's equity and revenue. These increase on the credit side and decrease on the debit side. The full terms are here: drawings, expenses, assets. These increase on the debit and decrease on the credit. And then we have liability, equity or owner's equity and revenue. These increase on the credit and decrease on the debit side. Drawings, expenses and assets have a debit nature. These increase on the debit side and decrease on the credit side. This is shown by these arrows. DR stands for debit and CR stands for credit. Liabilities, equity or owner's equity and revenue have a credit nature. These increase on the credit side and decrease on the debit side. So this is again shown by the arrow. Debit side is the left hand side of ledger accounts, T accounts, and credit side is the right hand side of the ledger and T accounts. Now let's understand the double entry system further. The double entry system of bookkeeping ensures each business transaction has equal and opposite effect in at least two different accounts in the accounting system. For example, if we buy a motor vehicle for cash, motor vehicle account will increase and cash account will decrease. Both of these are asset accounts. So one asset account is increasing and the other asset account is decreasing. And if we bought that motor vehicle on loan instead of cash, then motor vehicle will again increase, but now cash will not decrease. Liability will increase by the name of the person who has given us that motor vehicle. So this is how the double entry system works. We will discuss it in detail further. An account is a record in ledgers used to collect and store debit and credit amounts relating to an asset, liability, capital, income, or expense. For example, every transaction that involves machinery will be recorded in the machinery account, but there will also be a counter transaction in another account like we already discussed about the motor vehicles. So now, moving on to preparing ledger accounts, which are also called T accounts. We have to memorize the accounting equation, that is assets is equals to owner's equity plus liabilities. Every page of a ledger account is divided into half as we already discussed. The left hand side is the debit side and the right hand side is the credit side. The debit side can be abbreviated as DR and the credit side can be abbreviated as CR. The name of the account is placed in the center on the top of the account. If an account is to be debited, an entry is made on the left hand side, that is the debit side, and if an account is to be credited, an entry is made on the right hand side, that is the credit side. Now let's discuss this with the help of. So we have several transactions here. Helen deposited $45,000 into the business bank account. So bank is an asset. Asset is increasing. So asset will increase on the debit side. And against that asset, we are not bringing in a liability. It is owner's money that is being introduced in the business, which means that it is owner's equity. And owner's equity or capital increases on the credit side. So in the first transaction, bank will be debited and capital will be credited. Now let's discuss this in the T account as well. We can see that on the bank account On the debit side, we will write 45,000, which is the amount being introduced, and we will write the name of the other account from where this money is coming from. So in this case, it is coming from capital, that is owner's equity. So we will debit capital, that is 45,000, and in the capital account, we will credit bank, that is 45,000. So in short, bank account is being debited by 45,000 and capital account is being credited by 45,000. We will write the name of the other account in these for reference. Now we have our second transaction on May 5. The business bought a motor vehicle paying by check $7,000. So motor vehicle is being introduced in the business and we are paying by bank because a check is paid from the bank. So now bank account is reducing and bank account is an asset. An asset decreases on the credit side. So on the credit side of the bank account, we will write motor vehicle and 7,000. And the double entry for this would be in the motor vehicle account. Motor vehicle is an asset and it is increasing. So we will write 7,000 on the debit side and we will write bank. The third transaction on May 10, the business bought furniture from Offset Limited 4,500 on credit. So now furniture, that is an asset, is being introduced in the business. So furniture account will be debited by 4,500. And this time we are not paying by bank or cash. We are taking this furniture on loan. So our liability is being created by the name of Offset Limited and liability increases on the credit side. So we need to make two accounts now, furniture and Offset Limited. Furniture will be debited by 4,500 and we will write Offset Limited there, and Offset Limited account will be credited by 4,500 and we will write furniture there. So this is exactly what is happening here. Now just take a look at this. Furniture account has been debited by 4,500 and Offset Limited, which is a liability, is being credited by 4,500. Now moving on to the next transaction, that is on May 15. The business received a loan of 7,800 from KL Loans by check. So money is coming into the business's bank account, but this money is coming from loan, not from owner's equity. So bank will increase by 7,800, that is it will be debited by 7,800 and we will write KL Loans. And on the credit side, we will create an account of KL Loans and on its credit side we will mention 7,800, which is a liability that we have to pay back at some point of time, and we will write bank in the reference. The next transaction, that is on May 30th, the business paid Offset Limited, which was a creditor of the business, 4,500 by check for the debt owing to it. So now we bought furniture from Offset Limited earlier. We credited Offset Limited. Now we are paying Offset Limited to settle their account. So money is going out of our bank account. So our bank account will be credited by 4,500 and Offset Limited, which was a creditor, will now be decreasing as we are paying them. So we will debit Offset Limited account by 4,500 and this account will be settled and our bank account is being reduced or credited by 4,500. On May 30, we have another last transaction, that is the owner withdrew cash 4,000 from the business's bank account for personal use. So whenever owner withdraws money for personal use from a business, that is drawings, and drawings increase on the debit side. And against that drawings, bank has to be reduced by 4,000 because money is going out of the business and an asset is decreasing. So we will credit the bank account 4,000 and we will write drawings in reference and we will create a drawings account, and on the debit side we will write bank and 4,000. So this is all about this example.